Today we're taking a look at an alternate version of exercise 5-10 on page 257 of the textbook from chapter 5, reporting and analyzing inventories. This is a problem looking at the lower of cost or market value. So the problem says that Martinez Company's ending inventories included the following items. They have helmets, bats, shoes, and uniforms. They have different unit levels of each of those inventory items, and the prices that they paid for each of those are listed. They paid $83 for the helmets, the bats $128, shoes $158, and uniforms for $60. What happens though periodically is sometimes the market value of inventory changes. Maybe there's a flood of goods and prices go down. Maybe that the goods become obsolete or they lose their value because there's a better product. So market value will affect what we list as the inventory value for assets under a rule called the lower of cost or market. What we do is we calculate what the cost is and what the market is, and we go with the less as the value for that unit item in the company's inventory. So let's just go through the example here and it'll all make sense. We're going to compute the lower of cost or market for ending inventory applied to each product level. So first off, we have the data. We're going to figure out what the total cost was. For the helmets, we're going to take $40 times $83, and that comes up with the total cost of the helmets of $33.20. The helmets have a market value of 90, so we're going to take 40 times 90, and the market value, we're going to do all the cost first. The 28 times 128 for the bats, the 63 times the 158 for the shoes, and then the uniforms 70 times 60 for 4,200. Altogether totals 21,058. Now let's go back and take a look at the market. So with market, 40 times 90, 28 times 118, 63 times 151, 70 times 60, so no change between cost and market for the uniforms. That all totals up to 20,617. Well, we're going to have to go into each type of inventory and we're going to apply for that specific type of inventory either the lower of cost or market as the amount that will carry for the value of that specific type of inventory. So for helmets, which value is lower, the cost of $33.20 or the market of $3,600? Well, the $33.20 is going to be lower, so we'll say that's the value of the helmets. For the bats, $35.84 versus $33.04, which is lower? Well, the $33.04 is obviously lower, so we're going to carry that at $33.04. Moving on down, shoes, $99.54 and $95.13, which is lower? Well, the $95.13 is indeed lower, so we'll carry that at the $95.13. And then the uniform, exact same cost as market, so we'll carry just the $4,200. Well, we simply just total those values up. $33.20 plus $33.04 plus $95.13 plus $4,200. That gives us the total value of our inventory of $20,337. So that's the amount we want to actually mark inventory down to. Remember, our inventory, we're listing it at cost at $21,058, but under the lower of cost or market rule, we're going to say, well, the inventory is really only worth $20,337. So we've actually had a write down or a loss of $721. That's the $21,058 minus the $23,337, and that's the loss of $721. We're going to do that as a year-end adjusting entry to inventory. And the journal entry is going to look just like this. We're going to take cost of goods sold, and we're going to debit cost of goods sold. That means we're increasing our expense called cost of goods sold, and we're going to be crediting inventory, merchandise inventory, to lower down the value of inventory. And then the reason we did that was to adjust inventory cost to its market value. Okay?